Hi folks, Scott here, and this is the wrap for Monday, August 19th. So another weekday, a little bit surprising actually, not shocking, but a little bit surprising after the weakness we had at the end of last week. And I'll talk about today in just a moment. But going into tomorrow, I thought it'd be interesting to share the results of fading gaps after 4 consecutive lower daily closes. So today, Friday, it's the blue line. Thursday's low close. And then Wednesday's low close was somewhere up there. In fact, it's probably easier to see on a daily chart. There you go. 1, 2, 3, and 4. So the first day, 4 days ago, was still inside of its range. It's almost a head and shoulders pattern. So 4 consecutive lower closes while above the 200-day moving average. You can see we still have some unfilled gaps down here at 35 and 27 down below. So you never know. 2 closes below the 50-day moving average here is going to get some people's attention, some systems and funds as well. I think the cash index closed below 2 days in a row too. Yeah, see? So if it's going to hold here, it's going to have to do so somewhat quickly, or you could take a deeper dive, so like what we did back in June. I have no idea. None at all. Nor does it matter for me to be successful. That's why one of the reasons I trade intraday. I don't try to predict directions of the market. Too hard, too many variables you can't predict. Let me see. So let me go to Gap Trader, my back testing tool. Show the results. Fading gaps when above a 200-day moving average after 4 consecutive lower daily closes. And as you might expect, pretty rare. It's only happened on average about 3 times a year over the past 10 or 11 years. Odds favor a gap up. That stands out. Now, granted, this is a small sample size, but that's still pretty darn lopsided, right? 3-to-1 odds of gapping up. So clearly long bias there, and that's also confirmed by the fact that 7 of 8 down gaps have filled or at least finished positive by the end of the day historically. And on a gap up, it's less than 50% chance of finishing below the open. And or filling. Let me just double check. That's targeting gap fill. 0 is gap fill target. So only 11 would have filled or finished below the open historically. 12 ran against you, finished above the open. So clearly a long bias. Odds of gapping up are higher. And as always, I'll defer to our gap guys before I make my final decision. But on the surface, I certainly will be thinking and looking for opportunities to get long. And we'll wait and see exactly what our worksheet and gap guys show tomorrow morning, as well as any of the other unique patterns that may be in play. I'm trying to think if there is anything that stands out. It's not a special day. It's the 20th. It's Tuesday post options expiration week. That's really not a special day. Yeah, don't think so. 4 lower closes stands out as a pretty significant one though. So we'll see. All right. Today was actually a very quiet day. Let me show you the worksheet. We ended up with nominal gaps. I'll just show you the worksheet. Worksheet's a summation. The summation of our 8 individual gap guides. This is where most of our members start their analysis. Then they look at the individual gap guide for the market they plan to choose. You never want to fight the broader market. That's what this is. And as a reminder, I got an email from I'll call him a long-term prospect. He's been watching our videos for over a year, I know, maybe a couple of years. And he's still interested in becoming a member, can't quite pull the trigger. But he gave me he's a bright guy, he's given me some good feedback. And he says, you might want to make it clear that you are fading the gap each day. Because these videos are for both our members and non-members. I'm fading, meaning I short up gaps if they meet my criteria, or buy down gaps. So all of these assumptions, these have to be by definition to gap above the high or between the high and the close. Gaps up. So these are odds of gap fill. That means you'd be going the opposite direction, shorting them to get to gap fill. And today, pre-market, we were below the prior close for most markets for most of the morning, and there was 73% chance or 59% chance. Now we end up with a nominal gap. What you should point out is that this is the most important thing at a glance. If you had 10 seconds to make a decision, this would be the page. Which, by the way, if you only have 10 seconds, don't trade. Hopefully you know that. But this was right at 60 and more than 1.3, greater than 60 and greater than 1.3, greater than 60, greater than 1.3. So technically the average across all 8 indices showed good setups today for fading. Monday post OPEX, small sample size, but a little problematic. And all of these assume our MTG intraday stops. These are weak numbers, so it tells you market's a little bit unstable historically after Monday post-OPEX when you finish below the 10-day moving average. No unique patterns from my database noted. I always do a little additional work at the end of each day for our members in our trading room, and then I share it here. And it was in this weekend's video wrap I talked about fading gaps on Mondays after a 20-day low close and above a 200-day moving average. Down gaps a little bit problematic, up gaps a little bit more attractive. See, gaps in August, I've shown this most of the month, generally good in either direction when you're below the 10. And then cowboy gaps, this was not applicable today. This was if we gapped up in the DFC zone under the low 2 days prior. It's a real nuanced but important setup. It happens fairly much. Just because it's a nuanced pattern doesn't mean it doesn't happen much or that it's not important. It's a very important 2-day momentum pattern. It's explained in our member download area. I've done entire articles on that one setup in the past. And very unusual. It's normally a positive setup for fading. Today it was not, had we gapped up. But all this is really just noise because we ended up with basically no gap. So I was willing to trade, but I needed the indices gapping in the same direction to account for the small payoff, and we just didn't have that today. So it needed to be large enough to the upside or small enough, but not too big, or it needed to be down below 1650 in the ES. And I need the NASDAQ gapping down. So didn't happen. We ended up with basically no gaps. In fact, in the futures, you can see precisely no gap. Normally, you look for a white line. The white line's open on my charts. There is no white line because it opened right at 1651. See, Russell opened by a tick to the high side. NASDAQ opened a few ticks to the high upside, and Dow opened down a little bit. So no trade for me. Left it alone. 15-minute range guides came out. They showed a slight bias for the high fade. I don't know if anyone took it. I didn't hear from anyone specifically. Reasonable trade. You would have taken some heat though. 4-point stop, 53.50. You would have survived and had a winner today. Clearly there was a bias for the high fade for both the 15-minute and first hour numbers. They weren't strong enough for me to trade, so I passed on them. And nothing else really looked attractive. So I had a very quiet day, which of all days, Mondays is most likely to be my quiet day. I will point out anecdotally or just from my experience of staring at charts every morning for the past 10 years, with missing very few days during that time, and wrapping, just basically keeping up with the charts each day. This is a discretionary setup that's a pretty good one, and I say it's a pretty good one because it meets a couple of my criteria here. I did not trade it, by the way. It happened sort of during the doldrums, and I wasn't watching the market during this time because I rarely do. But in the spirit of trying to teach you something or share an idea with you, look at the low here. The low, 47.25. That's more than 2 points below the red line. Red line is the low from Friday. So it broke down, violated the prior low. It also broke the Globex lows. If you go back and look at the Globex lows, they're around 48.25, I think. So we broke Globex lows. We violated the prior low by more than 2 points. And then we rallied, came back, and tested it. This is a very good setup. If you break a key level, especially like a low, when you have momentum to the downside, you can short bounces to the next resistance area, potential resistance area, which the low is a great one. And to make it even better, we have the close just above it. So you could get short at 49.25 with, say, normal 3-point stop is what I would have used, and hold for the next potential resistance area or support area down below. Risk 3 to make potentially a lot more because you can get some tremendous trends when you start trading outside of the prior day's range. And that was a pretty good one there for a pretty quiet day overall. You could have made, if you nailed it perfectly, would have gotten close to 6 points. So just a thought. And for me, my preferred way to do these trades is when I have some type of a directional probability-based bias. I'll run numbers in our trading room in the morning and look at end-of-day odds, often closing odds, and if they show a bias, then often that's when I start looking more aggressively for any entry, right? 15-minute, first hour gap, discretionary trade, whatever it is. Otherwise, you're just better off sitting on your hands and wait until a probability-based setup. Anyhow, that was my day, and that is the wrap for Monday, August 19th. Have a good one.